welcome everybody to this joint webinar organized by IFoA and the Actuarial Society of Malaysia. We thank you for taking out time, and some of you might be actually skipping your lunch or delaying your lunch. So thank you very much for joining us. We have got a very good number of participants still trickling in, so you might just give it another minute before we start with the presentation. In the meantime, I can just give you some house rules. So this session is going to be recorded. So I hope you're all okay with that. You will all be placed on mute during the session. However, there is a Q&A box at the end, towards the bottom of your screens or top of your screens, depending upon how it is set up. But you should be able to ask questions as and when it comes to your mind. You can just type it in the box, but we will be taking the questions towards the end of the seminar, and there will be around 15-20 minutes allocated for it. If we are not able to fully answer all the questions, we will try and answer them offline and circulate it via IFoA or ASM, as the case might be. So while we are waiting for others, I will quickly start with my introduction. Now, my photograph is somehow missing here, but you can all see me. My name is Charchit Agrawal, and I'm an actuary, of course, and I have worked across different geographies so far, and my area of specialization has largely been general insurance reserving, although I have had some stints in capital here and there. And I have been in Malaysia for almost 2.5 years now as the appointed actuary with QBE, and I have always been associated with the IFoA. So yeah, that's about me. Over to you, Saunak.
Yes, hi everyone. Good morning and good afternoon. And just to tell briefly about myself, so I am currently working as a pricing actuary in Swiss Re for the past 3 years, and I'm working for the Casualty Asia region. Before this role, I actually have worked mostly in the primary lines pricing. I've worked in different LOBs, starting from motor, health, casualty, liability also. And in my current role, I work across different geographies in Asia, and I'm heavily involved in the pricing activities as well as a lot of analytical activities. And this is actually a very busy time for us because we are doing the 1/1 renewals, but really happy to be here and kind of impart my knowledge on crop insurance, whatever I've learned with Charchit during our research in the GI Asia Working Party. So thank you.
Sure, thank you, Saunak. So just a quick disclaimer. So the views expressed in this webinar are our own personal views based on the research that we have done in preparation for this webinar as a part of the GI International Asia Working Party. So you might have attended other webinars by our working party. This might be the last for this year, but yeah, we are having more in the pipeline for the coming year. Okay, so with that, I will probably, and we have, the number seems to have stabilized as well. So maybe I can now start with the agenda for today. So we are going to give you a quick background of the Indian insurance market, how it has evolved in terms of the crop insurance. What does the market distribution look like as it stands today? So those are my sections, and then Saunak will be covering some more technicals around the current crop insurance schemes, how the financial performance has been. And I think one of the focuses of for today's presentations is around the pricing process of the crop insurance. And I think what we are going to try and show is how it differs from a regular pricing process. And there are some differences. So some of you might have been involved with pricing usual GI products, and while there are a lot of similarities, so pricing is pricing at the end of the day, but we thought it might be worth touching upon how crop insurance pricing could be different to a usual product pricing. And then there's a further scope section, and where I think we'll talk about how this field can evolve and how actuaries can contribute more, as well as I'm going to briefly touch upon a survey which was conducted by AXA XL Reinsurance back in 2018 around the three countries, Brazil, India, and China. So we'll just see how the three markets compare, because there are some similarities in the three markets here. So it might give you some insights. And then I will talk a little bit about my understanding of how things are in Malaysia, because I believe some of the audience, quite a number of you are from Malaysia. I don't have a lot of understanding of the Malaysian crop insurance market, but I did speak to my colleagues, so I'll try and share what I can, and happy to have any discussions on that. Okay, so in terms of the background, as you might know that for India has historically been a very heavily agriculture oriented economy, and this share of agriculture in the total GDP has been on a downwards trend, as I think happens with a lot of economies. As we get more urban, things start to less and less, the contribution to the GDP starts to go down over time from the agricultural activities, and manufacturing and service sector starts to pick up. However, interestingly for India, despite its, I'll show you the stats in a second, but despite the fact that we are seeing a downward trend in the GDP contribution, still a considerable portion of the employment is in the sector. So I think almost 50% of the workforce is directly or indirectly involved in agriculture, which is to highlight how important this sector is. And if you do follow the news about India, there have been quite a few unfortunate incidences of farmer suicides. There have been cases where there have been the rains have not been so great, and so when I say rains, so it's still, despite the progress made, and there has been a phenomenal progress made, I would say, in terms of the sector, but despite that, roughly 50% of the irrigated, so 50% of the farmland is still not irrigated, in the sense of it is still dependent upon the variability of the rains in a particular season. So that shows how much importance crop insurance could have for a country like India. So as it stands today, crop insurance, agriculture contributes to around 17% of India's GDP, which is still a substantial share, although, as I said, it's on declining trend. It used to be as high as 35% closer to independence, but now it has been coming down. And we still have 138 or odd farm holdings in the country, which is a huge number. And one interesting fact, which I'll touch upon later on as well, is that the farm size matters quite a lot when it comes to how efficient agriculture can get. Now, for us in India, there's about, as the stats say, almost 85% of the farmers hold less than 2 hectares. And if I were to compare this to more advanced countries, the number is much bigger. But I'll talk more about that when I come to my survey from AXA XL. Sorry. So this is what the evolution of crop insurance in India has looked like. So it started all the way back in 1972, but it was very basic form of insurance. It did not really kick off on a big scale until 1985, when we had the comprehensive crop insurance scheme. So I won't be going into the details of each one of them, but you can, this slide is to give you an overview of how it has been in the workings. It has been evolving. We launched the WBCIS, which is the weather-based crop insurance scheme. So this is based sort of a parametric insurance in a way, and which has been relaunched in 2016 as the restructured weather-based crop insurance scheme, RWBCIS. And the most recent scheme that we have is the Pradhan Mantri Fasal Bima Yojana, which is acronymed as PMFBY. So you will be hearing this PMFBY over and over again in this presentation. But so PMFBY stands for the most recent agriculture insurance, crop insurance scheme launched under the Prime Ministership of Modi in India, and it is in many ways a huge improvement over what we had in the past few schemes. So just to give you a very quick, what were the limitations of the original schemes? That the biggest limitation was that the penetration was quite low in terms of the agricultural insurance in the previous schemes. The current scheme has, I wouldn't say it has exponentially grown it, but it has significantly grown the coverage of crop insurance across the farmers. And the other major issue was around the premium and the sum insured. So previously the government was, well, it is a state-sponsored scheme, so it is heavily subsidized by both the central government and the federal and the state government. So just like we have it in Malaysia also. Yeah, I keep thinking whether I'm talking about Malaysia or India. I'm representing both countries here today. But so we have the states and we have the central government. So the central government's budget is separate to the state government's budget. So this is being partly subsidized by the state government and partly by the central government. And what was being subsidized before was the claims part and not the premiums part. So the premiums were still there. There was heavy pressure on the premiums for them to stay low so that the farmers don't have to pay a lot of money, and quite a lot of things happened around that. So there wasn't enough participation, and the premium rate was quite high for the farmers as well. Compared to what has happened now in the PMFBY, the premium rates have been capped at 2% and 1.5% on the two seasonal crops that we have. Also, so just to give the background, and I think Saunak will be referring to these terms, we have got two major crop cutting seasons in India. One is called the Kharif, another one is called the Rabi. So one happens around the Deepavali time. So that's why part of the reason we celebrate Deepavali is because of the crop cutting that happens. So rice is the major crop that is cut in around Deepavali time. And the other one happens somewhere close to spring, where we have the wheat, which are the two very big staples in India. And we have the festival of Holi around that time. There's a bit of cultural touch to it. And then there have been a lot of delays in the assessment and settlement of claims in the past. So India is still using the crop cutting experiments, which are quite manual. So crop cutting experiments, CCE, refers to the fact that you go and, depending upon the area you have defined for insurance as a unit, you just take a sample from that unit and just check what the average yield has been. So if I try to bring it to the context of Malaysia, I think we had something similar for the extraction rate for palm seeds. So we see how much extraction has happened in terms of the average, historical average, or the average of the last few years. And Saunak is going to talk more about that. And based on that CCE, the crop cutting experiment, it will be decided how much claims should be paid out and how much has that yield, how much that yield is in comparison to the average yield which should have been, and the difference of the two is going to determine how much claims are going to be paid out. So and that process has been very manual in the past, and it takes a lot of time. So by the time the crop cutting experiments have finished and then we decide how much claims to pay, it is already quite late, and then the next sowing season has already arrived. So the farmers haven't still received the claims from the losses they made in the previous sowing season, and that this cycle was a vicious circle where they can't grow the next crops, and so the loss ratios were high, the premiums could not be decided, and so on and so forth. So the CCE hasn't gone away in the PMFBY, but there are talks of greater use of technology, and so things are looking, although there are some limitations and shortcomings of even the latest ones, but we will talk about that in a bit more detail next time. So here is, I won't spend a lot of time on this slide, it's quite visual. So we used to have a dedicated insurance company for the agriculture called the AIC, Agricultural Insurance Company, which used to be almost 100% insuring the crops. But now the sector has been opened up to private participation. On the table to the right, you can see the ones in orange are the public sector companies. So India has 4 public sector general insurance companies other than the agriculture insurance companies. Agriculture insurance is the dedicated agriculture insurance company. But other 4, National Insurance, New India, Oriental, and United India, they do write all lines of general insurance in India, and the ones in green are all private sector companies. So you can see the The contribution of the private sector is almost, I would say, half now, and the national contribution for the public sector companies is almost another half, of which 30% is still coming from AIC. We had some high-profile departures from the private sector, such as ICICI Lombard, Tata AIG, who recently exited the crop insurance market, and I think Saunak will talk a little bit more about that. And here I remember, my apologies, there was supposed to be a survey question. So Sylvia, I'm sorry, I think I've overjumped a few slides, but maybe we can do both the survey questions together. So if you could launch the first survey question, please, unless it is related to the slide. Okay, I think this is still worth doing it. So I think this number has already been talked about. So let's see if people can still remember paying attention to what I'm speaking or not. So the survey was supposed to come in before I revealed the number. Very good, very good. Keep going, keep going. Half the responses are already here. I think. Okay, I think we have got quite a high response rate. So maybe Sylvia's time to show the results. Okay, so 3.5 billion, that's not the right answer. The right answer is 4.5 billion, but it's okay. Should pay more attention next time. Okay, and then could we go to the second survey question, please, Sylvia? Okay, so if we haven't talked about this number, you just want to take a guess. I think we talked about this number actually. Can't get this one wrong. Okay, I think we can. Okay, okay, very good. Yes, I think this is pretty much on the screen right now, so I'm not sure why some of you have got it wrong, but okay. So let's. So for the next one, I am going to hand over to Saunak. So Saunak, over to you. And I'm not sure if you want to do another survey before you move on to the next one. Is there another survey before this?
Yes, so there is another survey, but before that, quickly, actually, I just wanted to draw some points in this particular slide. So first thing is, from the time the crop insurance scheme was launched, especially the PMFBY scheme in 2016, this is basically a evolving scheme. So the government has a lot of good intentions with this scheme. They wanted to achieve something, but there were some problems which were there inherent in the scheme, which they're still trying to rectify. And the most critical aspect for an insurance company in this crop insurance scheme is selection of the state. So I will obviously talk about PMFBY in much detail, but a lot of insurance companies, empanel insurance companies who write the crop insurance schemes, their fortunes vary wildly with the states they kind of win. So it's a bidding process where the lowest bidder wins a particular cluster, and accordingly that cluster will kind of derive your fortunes. So if you see this particular table, you can see that from 2018 to 2019, there were some very big private players like ICICI Lombard, which almost had around 24.5 billion INR crop insurance GWP in financial year 18-19. But from then, actually, they totally have exited the crop insurance market. I think one interview also came from Mr. Bhargav Dasgupta, who was the CEO of ICICI Lombard, that they are totally exiting the crop insurance market, and they really have burned their hands by like going into some geographies. And a lot of that business have been taken over by Bajaj Alliance, which you can see in the first company in green. So it's a private player, and they have benefited largely from this, and they have grown by a huge portion. So just one thing to keep in mind, that some companies actually make good profit, but some companies which are not lucky enough to make the right selection of the clusters and the states, they actually end up getting their hands burned quite a bit. And in terms of the PSU shares, so they are broadly more or less same. They have around 6% market share, all the PSUs. And currently, in terms of the private players, Bajaj, HDFC, and SBI are the big players in the crop insurance field. And like Churchill already mentioned, and it was there in the survey question, it's a heavily reinsured portfolio. So insurance companies rely heavily on the reinsurance support, and almost 75 to 80% of the risk is ceded to reinsurers in the form of proportional stop loss protection. So before we go to the next slide, so Sylvia, can we just have that next survey, please? So this is a very simple survey. So before we actually go to the next slide, yep. So what are the parameters which are currently used in pricing by crop insurers? Okay. Yes, I think most of you got it right. So in the crop insurance pricing, there are two major things which insurance companies use. So first is the yield data. So by yield, the definition of yield is basically the agricultural production per unit area. And other than that, we actually also use some weather related parameters and some weather related information from satellite data to kind of help with the crop insurance pricing along with the yield data. All right. Okay, so we can close this survey. And in terms of the PMFBY, so Charchit already mentioned that it stands for Pradhan Mantri Fasal Bima Yojana. So this is the Hindi word. The literal English translation means Prime Minister's crop insurance scheme. So Fasal Bima means crop insurance in Hindi. And it is basically a area yield based insurance scheme. So I will just kind of discuss why we are saying it's a area yield based index scheme. And it dominates the crop insurance portfolio. So almost 90 to 92% of the premium, as per the latest statistics, comes from the PMFBY scheme. And this was launched with much fanfare in 2016. And it is designed to provide comprehensive insurance cover against your crop failure. And since agriculture is such a crucial aspect, and so many of the working population is involved in agriculture, it is very crucial to give them income stability. And the Prime Minister's office also makes a very big push for digitization and innovation. So a lot of like new changes happened in the PMFBY scheme, which was done with the sole intention to encourage your digitization and innovation. So in terms of the coverage, so it covers all types of food crops, oil seeds, annual commercial, horticultural crops, and it's covering over both the two seasons. So first is the Kharif, which is the monsoon seasons, which Chachit already mentioned, and another is the Rabi scheme, which is all the winter crops which comes. And the scheme is implemented both by the central and state government agencies along with the empaneled insurance companies. And to be a empaneled insurance company, the central and state government agency will actually judge you based on your experience of handling crop insurance as well as your financial strength, because crop insurance is a very big portfolio. It has a lot of it has a lot of focus in terms of the population. It's also a political and election issue, so it's very important that the empanel insurance company has the required financial strength to kind of implement the scheme. And the selection of the insurance company from this empanel list, to act as the implementing agency is done at a cluster approach. The reason it is actually done at a cluster approach, it is done to diversify and spread the risk, so that one cluster will have both high risk and low risk districts. So it's really not fair that if one cluster has all the like high risk profiles and another cluster has the low risk profile, then one company will actually will be left with a cluster which has only high risk, and one company will be left with only low risk. But still there are a lot of issues with the cluster approach, because still the cluster approach is not working properly. Some companies having a particular cluster are suffering badly, while some companies actually are making a lot of profit in that. So it's still evolving in that way. And a large state, suppose a state like Uttar Pradesh, which is one of the largest states in India, it might be divided into multiple clusters, so that the expected sum insured is minimized and the risk becomes sufficiently diversified among different areas. In terms of the implementation of the scheme is on area approach basis in selected areas, and that is the reason we call it area based yield index scheme. So in terms of area approach, we have selected areas which are called the insurance units, and the unit of insurance, it will be mostly at a village level for major crops. So India has a lot of villages, and we choose the unit of insurance at a village level. And the thumb rule to choose this is the sown area, the area where the crop is actually sown should be at least 25% of the gross cropped area. So Charchit already briefly mentioned about the crop cutting experiments. So it's a very crucial aspect of crop insurance scheme, because the yield, which is the factor for determining everything, your yield shortfall, the way the claims are being paid out, the yield is actually determined for an area as objectively as possible via these crop cutting experiments. So I will also briefly talk about the new changes in PMFBY. But uh, earlier, all the like the earlier PMFBY scheme, it didn't specifically say about the crop cutting experiments would use any kind of stratified sampling or smart sampling. But from 2020, the PMFBY is undergoing significant changes. We have a like full slide dedicated to it later on. But we are going to kind of talk about the new changes. But one very important change is, in the new scheme, it has been actually specifically mentioned about how crop cutting experiments has to be done using technology and as well as all the smart sampling techniques. So it's a very good improvement. Uh, and I already actually have mentioned before, but it's a tendered pricing regime, and the per cluster or the lowest bidder wins. So even though the actual premium rate, so this is the first time in 2016 that the actual premium rate was fully implemented in a crop insurance scheme in India. So 2016 was a landmark year related to that, because the actual premium rate came into existence, but still it is a tender pricing regime. And even after you calculate the actual premium rate, the lowest bidder is going to win the cluster. And in terms of the price, so the actual premium rate is to be charged under PMFBY scheme will be capped at 2% for the farmers for all kharif crops, and 1.5% for rabi crops, and 5% for your commercial or horticultural crops. So the farmer's premium is capped at that level. Remaining whatever is actually pending amount, that will be shared equally by this like the center and the state governments. So for an example, suppose the premium is coming at around 100 rupees, so 2.5 if it is 2%, so 2 if it's a kharif crop will be paid by the farmer, and remaining 98, so 49 and 49 will be split between the state and central government. But this is also changing with the new PMFBY scheme. And there is also a bit exception made for northeast states which are not that developed. So there it's a bit different, but mostly it will be your 50-50 share between the state and central governments. And so in terms of what is the like risks covered, so the basic risk covered is the yield shortfall of the standing crop, which is covered against all the natural calamities. So drought is actually one of the main calamities in India, and it's very frequent, and a lot of the crop losses comes from drought. But apart from that, you have coverage from flood, fire, locust attack, pest attack, all these things. And like we mentioned, that this yield shortfall is measured by crop cutting experience at a insurance unit level. And in the current crop insurance scheme, all the covers which were like the basic cover included both the standing crops as well as prevented sowing, mid-season adversity, and post-harvest losses. But the new PMFBY which is coming, there specifically it is mentioned that the basic cover is just going to be the standing crop. And in terms of the add-on cover, they have mentioned that the prevented sowing will be on notified area basis. That will be add-on covered. So what is prevented sowing is when the farmer is unable to sow crops due to adverse weather, then he is eligible for indemnity claims, which can go up to 25% of the sum insured. Also, the farmer will be covered against mid-season adversities. So it is basically an immediate relief provided to farmers in case of adverse weather conditions. And there can be also coverage against post-harvest losses. Post-harvest meaning the coverage is for those crops which are kept in the cut and dry condition to dry up in the field. So once you cut the crop, it is actually spread out in the field to dry, and the cover can be given up to a maximum period of 14 days. And the reason for this post-harvest loss coverage is mostly due to the cyclonic or unseasonal rains in India. So for the past couple of seasons, maybe also due to climate change, the rainfall in India has been very cyclonic and unseasonal in nature. And in terms of the indemnity levels actually is offered at 3 levels. It can vary between 70% to 90%, and it corresponds to the crop risk in the areas where all the crops are spread out from a low risk to high risk area. So for an example, a district suppose which has a very high historical losses, that district is actually given a 70% indemnity level, and vice versa. So it can be a reflection of the level of variability which is observed within an insurance unit. So this is briefly about the PMFBY scheme. And the other major scheme we have in India is the restructured weather-based crop insurance scheme. And it's a relatively smaller scheme as compared to the PMFBY scheme. And it accounts for around 8 to 10% of the premium. And the structure of the farmers premium, the selection criteria, insurance company area allocation, so all these basic things are all similar to the PMFBY scheme. So the basics structure follows exactly like the PMFBY scheme. And the claim settlement actually will be based on the predefined terms drawn from different weather parameters. So AWS is a weather website which gives you the weather information globally. So the claim settlement will be based on those predefined terms from weather parameters. And what this scheme covers is mostly horticultural crops such as vegetables and fruits, where you cannot actually use a crop cutting experiment to ascertain the crop yield. So these type of horticultural crops are mostly covered under the RWBCI scheme. And just wanted to mention for completeness of another scheme, which is the CPI scheme, which is called the Coconut Palm Insurance Scheme. And it is a very small scheme compared to PMFBY and RWBCIs. But for a few states, suppose Kerala or Andhra Pradesh, which has long coastline and it has a lot of coconut plantation, and coconut plantation has a big export value to this particular states, it makes sense to actually cover the decay or loss of these coconuts from the common perils it can face. So like flood, inundations, cyclones, accidental fires, droughts. So all these perils actually will be covered under this CPI scheme. And the claim settlement will be based on the loss assessment. So they have a dedicated coconut development board, and also there are other state agencies which can actually help with the claim settlement based on this loss assessment. Okay, so before we go to the next slide, can we just quickly have the next survey, please? Yep. Okay. So we have almost 63% kind of saying the right answer. So I actually briefly mentioned this in my talk. So, but drought is actually the one of the major perils for crop insurance. And in India, there has been few instances of very severe droughts, and which has affected the farmers a lot. So we are going to briefly talk about that. So I'm just closing this survey scheme. And uh, in this particular slide, we are just going to talk about the historical financial performance. So the left slide actually talks about the premium growth and loss ratio, and the right hand side graph actually talks about how many number of farmers are being covered and how the premium rate is moving. So just wanted to highlight that till 2015-16, it was all the earlier crop insurance schemes, which was NAIS or MNIS, which were or the erstwhile weather-based crop insurance schemes, which was still there in existence. From 2016, the situation changed completely with the introduction of the PMFBY scheme. So in this left slide, what you can see this from the last 8 years, actually the crop insurance scheme premium is going till 15-16. It's growing by a small margin, but then there was a exponential jump in premium. So there is actually like multiple reasons for that, but one of the main reason for that was the scheme itself actually underwent a significant changes. So what happened was until 2015 and 16, the National Agricultural Insurance Scheme, which is the NAIS, the premium rates were actually capped to make the premium affordable to farmers. And whatever was the additional claim liability over the premium, it was also subsidized by the government. But there were multiple problems with that, because you just cannot calculate the claim like in a very fast manner. So it's a very long drawn process, and it is actually dependent on your actual crop yields, and it is very much difficult to kind of estimate this actual crop yield outputs at the outset. So the government actually cannot ascertain the total budgetary requirements for a given year in advance. So what happened was, with the introduction of PMFBY in 1617, the claim subsidy was totally removed, and the focus was totally shifted to the premium subsidies here. It's an arrangement between a central and state government. So I already mentioned that the farmers still pay a very small part of the premium, and the premium implement is the actual premium rate for the first time. But mostly it is a premium subsidy share arrangement between the central and state governments. And since the entire claim liability under all the crop insurance scheme is borne by the implementing agencies, so then government has no headache. Actually, all the liability is upon the insurance companies to pay the claims, and it is much easier for the government to ascertain the budgetary requirements for a crop insurance for a given year in advance. And like you can see from this particular slide, so we were just talking about how the scheme changed. So this is actually the main reason why the premium received a significant jump. First, because it introduced the full actual premium rates, and it replaces the earlier claim subsidy. And the coverage was also extended pan India. So for PMFBY, it had received much more wider pan India coverage in 2016-17, and a lot of states signed up for that. And the sum insured level was also kind of increased. So all these factors actually like helped in the increase in the premium. And in terms of the loss ratio, so loss ratio was actually quite bad till 2014-15, And in 2015-16, India actually faced one of the most severe droughts it has ever faced. So there is a big report by United Nations also regarding the scheme, and the loss ratio performance become totally unsustainable. So we went as high as 385%. So the government acted on that, and once the PMFBY actually scheme came, the full actual premium rates were implemented. And in the right slide, you can see that this line actually shows the premium rate movements as a percentage of sum insured. And you can see that the premium rate actually received quite a good correction in 2016-17. So it increased to around 11% from 5%. And this actually resulted in betterment of the loss ratio, but still it is worsening across the last 3 years because of various reasons, from adverse weather to increased loss activities, etc. And in terms of how the number of farmers are being insured, so 2015-16, around 49 million farmers were insured under the earlier erstwhile scheme. The introduction of PMFBY actually really increased, and the farmer covered been increased by around 10 million. So 59 million farmers were covered. And in the next 2 years, what happened was, due to different reasons, it may be political and it may be disagreements over rate, a few states actually has opted out of the scheme in the last 2 years, which resulted in a slight decrease in the number of farmers insured. But with the new introduction of the PMFBY with the new guidelines, we need to wait and see that how things turn up. But it has not been a very smooth ride, though there has been a lot of improvements in terms of the premium rate and all. Still, in terms of the rates and all, because the rates have increased quite a bit, so there has been a substantial number of disagreements between the central and state governments regarding the same. So next slide, Sylvia. And before the next slide, can we also have the survey, please? All right, so I think we have a lot of questions. So this was basically a trick question. So crop insurance is actually a bit different compared to other schemes, because here we neither use loss data or we use exposure data. What is used in this data is actually the historical yield data, which is used to calculate the yield shortfall. So I will describe how exactly it is calculated in the next slide. But it is very unique scheme because we don't rely neither on the loss data, because it's just not available. And the way the scheme is set up is the claims payout is based on the yield shortfall, and exposure data also we don't use. So the correct answer will be A, the historical yield data. So next slide. All right, so just can you do the first two boxes? All right. Now, in terms of the data collection, I actually wanted to use this slide just to briefly talk about how the crop insurance pricing process works in the market and how it compares with other major lines pricing process, suppose say motor, which is the biggest line of business in India. And the reason I have done this slide in such a way is because uh, the actuarial involvement in the crop insurance pricing is still at a very nascent state. So some actuaries are involved in the risk-based pricing of crop insurance, but definitely there is lot much that needs to be done from the actuarial perspective also, and there are a lot of scope from actuaries who can actually go into not only the traditional pricing, but also there are a lot of non-traditional areas which is coming up. So in terms of the data collection we get normally it's a good practice to get the historical yield for a minimum of 10 years. And we get this yield data for 10 years at a insurance unit level, which is basically the claim settlement level. And other than that, we also need some other information like sum insured to understand what is the level of coverage. We also need the loss ratio performance to understand the historical loss ratio of the state or the cluster and other zone area details. So, sadly, what happens uh, in this crop insurance pricing scheme, it is based on a tender-based pricing regime, and you have to rely on the data from the state government agencies. So most of the times what you mostly get from them is just the historical yield data. So even if you really want the other information like SI indemnity, what are the crops covered, claims info, sometimes those information are not fully available, and the data quality is not of a good quality. There is a lot of challenges with the data. There are a lot of missing fields. So it is improving year on year, but the past data is really a big challenge for the crop insurance scheme, and it leaves a lot to be like rectified in the past years. So you have to really rely on the recent years to actually kind of come up with your pricing process. But at the same time, because the new data you just have for the last few years only, you don't have any option, but you have to rely on this old data also. But there is a lot of challenges with this data. And when you compare with other major lines pricing process, so the best part is if for motor or other lines, you don't have to rely on an external state agency. You have your in-house credible data. So the loss and exposure will be there with you, and it is of good quality. So this is a very big difference. So actuaries who actually want to work in crop insurance really need to understand how this tender process works and what are the challenges with the data. Because once you kind of have an idea of how bad the data is and what are the way around with that data, then only you can actually proceed with the actual pricing. So next two boxes, please. Yeah. And in terms of the threshold yield, so what the threshold yield actually means, it is a benchmark yield level, and it is where the insurance protection shall be given to all the insured farmers in an insurance unit. So we calculate a benchmark yield level, and it is calculated as a moving average yield of the best 5 of the past 7 years, and it is multiplied by the indemnity level. So till currently 2019, the only threshold yield which was allowed was only on fixed basis. But from the new guidelines which is coming from 2020 Kharif season, is it can be calculated on multiple ways. It can be fixed, laddered, or on variable basis. So the formula I have already mentioned here is basically the sum of best 5-year yield into the indemnity level by 5. And we actually require this threshold yield for multiple reasons to calculate the shortfall in yield. So we use the threshold yield minus the actual yield, which gives you the yield shortfall. And once you get the yield shortfall, you can calculate the claims payout and other things by multiplying it with the indemnity level. And in terms of when you compare with the normal pricing process, we don't have any concept of threshold yield, but only threshold we consider is a large loss threshold, which is mostly to separate the attritional and large losses. So threshold yield is very unique to crop insurance, and it's one of the most critical aspects to calculate the threshold yield, because if the threshold yield is not calculated properly, then your whole claim payout will not be calculated properly. Next two slides, please. Yeah.
Saunak, I'm just one point. We are just conscious of time. So if there are
Yeah.
any parts you can skip and or
Yeah, sure. So just give me 5 minutes. Just I will just
sure.
take two. Yeah. And then comes another very crucial aspect of the crop insurance process called the detrending part. So detrending, as the word suggests, is basically the removal of trend. So normally what we do in India is we do a removal of linear trend, which causes distortion from the historical time series data. So there can be different distortions which can happen. So sometimes the distortion can be due to some positive trend which is observed in the past trend data. So positive trend can be your technological improvements in farming practice. So right now technology is changing at a very rapid pace. So there can be different technological improvements because of which your crop output can be really increased, or by using some kind of fertilizer you have increased your quality of inputs. Or there can be a lot of negative trends. So a region or a crop which can be severely impacted by some major calamity, or suppose the data has not been appropriately gathered at an insurance unit level. So all this will cause a negative trend. And so what we do is, suppose there is a positive trend, then we actually kind of increase the past yield, and if there is negative trend we actually do the exact opposite, and that's how we remove the trend. So it sounds easy, but it actually is done using a lot of like complex statistical and actuarial techniques. But the main like uniqueness about the crop insurance part is you just cannot rely on your technical aspect only. So you just cannot sit in your office and just talk about your statistical and actuarial techniques. It has to be complemented by your business experience. So all the experts who are actually at the field level, or underwriters who actually visit the field, you need to actually also have their experiments on how you should do the retrending, because sometimes what you get from your technical assessment might not reflect what's there in the ground. But in the normal pricing process, we actually do the exact opposite. We actually do the trending or on leveling to bring everything, all the past loss and exposure to current date. And we also like develop the losses to ultimate position, for especially for long tail liabilities. So next two slides, please. And historical burning cost. So this is also very unique. That's why I like mentioned in the survey question that you actually need your historical yield to calculate the burning cost. And the way the burning cost is like calculated in crop insurance is very different from how you calculate the burning cost in your normal other lines. So you calculate your threshold yield, like how I mentioned before, and the difference between your this threshold yield and actual yield divided by the threshold yield will give you a burning cost. So just to give you an example, so based on various crop cutting experiments, the threshold yield is suppose which is has been kind of calculated is 10 quintal for a particular region. But the actual yield is suppose say 8 quintal. So what the shortfall is your 2. So that is something which you have failed to do, which you would have done in normal circumstance, and it's a basically loss suffered to you. So that difference between this threshold and actual yield, which is 2, when you divide with your actual threshold percentage 10, that 2% will be your historical burning cost. And we calculated this burning cost historically for 10 years on the detrended yield data, and the average is taken as the unit level burning cost for a given crop. But like for normal pricing process, the way we calculate burning cost is a bit different. So we calculate loss per unit of exposure. So even though it's basically doing the same thing as a proxy, but we are not using the loss data for crop. And we use a lot of advanced model like GLM to calculate the like burning cost that we can do separately for frequency severity also, but we don't use that. It's still actually at a very rudimentary phase, the burning cost calculation for crop insurance. So next two slide, please. And heterogeneity load actually is done because it is required, since some of the historical yield data is on a much coarser resolution than the final loss settlement. So which means that the volatility is not represented well enough in the historical data. So for an example, so suppose the pricing data is at a higher level of granularity, suppose it is at a district level, but the claim settlement is done at a lower level, suppose it's done at a village level. So there is a mismatch in that. And sometimes the data, like I mentioned, it is only partially available at a lowest level of hierarchy. So maybe it's only available for 3-4 years. So as the lower levels of granularity lack statistical credibility, it can actually bring more volatility in the experience, and this can increase your pricing risk. So there are different ways you do heterogeneity loadings. I will not go into the details, but it's an area where the actuarial involvement can really add value. So people can play around with credibility-based methods. You can use simulation. Normally what's used is the standard pricing matrix, which is prescribed by the national regulator, which is GICRE in India. But there is a lot of scope for advanced methods also. Okay, and other than that, we do all the loadings for different catastrophic events. So a lot of cat events like drought or flood can happen. So we do loading separately for that. And the cat modeling is also a very sophisticated exercise. I mean, there is tailor-made softwares to do that. And other than that, we actually have to use the recoveries for direct and indirect expenses. So PMFBY actually mandates a specific portion of the premium for marketing activities. You have to buy weather data. So all these costs you need to add up. And uh, and other than that, you also have reinsurance cost, capital cost, profit margin, which you need to load. So this is mostly same as what you do in other lines of business. And finally, you arrive at the commercial rate. So next two slides, please. And you finally, once you have your like final risk premium, you apply some loading or discounting, and you kind of go for the tender based on that final commercial rate. And sometimes the state governments or even the reinsurers might mandate a 75% of target loss ratio, and it has to be maintained both at the tender and portfolio level. But when you see the commercial rate for any other lines, it is based on a sophisticated risk-based pricing. It is very dynamic in nature. You have very detailed market dynamics. There can be brokers, competition. So it is slightly different how you do in with other major lines pricing process. So next slide, please. And finally, once you calculate all these things, you get your full risk premium, and it is made of your burning cost and heterogeneity and cat loading. And on top of that, you kind of do all your loadings, which I've already mentioned, admin cost, your how much profit you want, the cost of the capital, and other external long-term contingencies, and you come up with your final rate based on that. So next slide, please. So I have already talked about few changes. So the major changes which is happening in this PMFBY scheme from 2021 is till 1920 it was a 1-year policy tenure, but from the new Kharif season it has to be mandatorily minimum 3 years. And another very big change is the crop insurance scheme was compulsory for loany farmers. So farmers who have availed a loan, it was compulsory for them, and it was voluntary for non-loany farmers. But for the first time in India, a crop insurance has been made optional for all farmers. So going forward, it is no longer compulsory. Even for loany farmers, it is optional for everyone. So what is covered, I have already mentioned in detail. So right now it has changed a bit. So earlier everything was on basic. Right now only standing crop is covered on basic coverages, and remaining other things has been put on optional. And the way the threshold yield was calculated earlier was fixed basis. Now it's on fixed laddered variable basis. And central government subsidy, it is still equal share, but right now what they have done is the central government has put a cap for irrigated and unirrigated crops, which can be 30% and 25%. And another big change was the use of technology. So earlier it was not mentioned, but right now specifically it has been mentioned that you need to have satellite imagery for the crop cutting experiments, getting yield estimates. So it has been specifically mentioned in the new working guidelines. And also smart sampling, like I mentioned earlier, it was just allowed, but it was not mandated. But now it is compulsory to have smart sampling, stratified sampling to optimize the crop cutting experiments. Okay, so next slide, please. So I think, thank you. So I'm done with my part. So maybe Charchit, you can just quickly drop in and just finish off this slide. Yep.
Sure. Thank you very much, Saunak. Very interesting. Okay, I mean, I'm conscious of time, so I'm going to take just 30 seconds and quickly go through this. So this slide is basically giving you a comparison between Brazil, India, and China as to how they kind of compare with each other. And the crux of the whole thing is that all three economies are having a heavy subsidy from the government. Brazil, much less compared to China and India. And the reason I wanted to bring this up is that what that report brought out was that the government subsidy can sometimes be a hindrance to the whole crop insurance regime, because it brings in politics into it, and the aim of the government is to maximize the spread of insurance so that maximum farmers can be benefited. Whereas if you were thinking of just purely from an insurance perspective, you might want to have more creative products. The farmers might want to have more creative products, and they might want to have some personalized insurance, because right now the insurance is being based on the area yield methodology. So even if your particular farm is more or less impacted, it doesn't really matter so long as the area yield has not been impacted. So these are some of the issues that I wanted to bring out. And the other one is, if you can see Brazil, the average farm size is 63 hectares compared to India, which is 1.3, and China, which is 0.6. And but however, what the report suggests is that the China is, despite the small farm size, they have still been able to kind of do more technology compared to what we have in India. So farm size is one criteria, but there could still be innovation happening around that. So I promise 30 seconds. I'll stop there and just open the. I mean, if you want to read more, you can just Google the Excel survey, agricultural insurance survey, and it is quite a nice detailed survey there.